Hello, so today I just wanted to quickly run through the basics of the stock market, what it is, what the numbers really mean, and how you can get interested in it. Well, a stock is simply a part of a company. So if I were to own, say, part of your house, maybe one room, that's similar to owning a stake within a business. You own a little part of it that makes up the whole. Now, when the company profits, that means you are owed part of those profits as well. That is what creates shareholder value. And that is why businesses are so focused on optimizing profits to increase shareholder value. Now, it can seem very complicated at first, of all these companies and all their different requirements for what's needed and what they should and shouldn't have. But really, when you break it down, they're all the same. You have a business, the business makes X amount of money, therefore 10% of that is worth 10% of X amount of money. The reason they only fluctuate is because you never know exactly how much money a business is going to make, either today or in the future. How long the business is going to survive, what market trends are going to hit it. Are people still going to want CDs in 20 years from now? And all of this is based on predictions and probabilities, and that's why the prices can fluctuate a great deal. It's also why you can make money if you could predict the future. But unfortunately, most of us can't. And putting all your money into a single stock is incredibly risky, though it can provide good returns. As a long-term strategy, what you should be looking to achieve is a good range of diversified stocks that continuously seem to go up and are most likely to indicate future successes. The easiest way to do this is through an index fund. My personal recommendation is to use Vanguard, as they provide some truly brilliant index funds that make investing exceptionally simple, quick, and easy. Simply look through the different range of index funds, see what they hold, and look at the annualized percentage returns. Now, of course, the old adage, past returns do not guarantee future successes. But if we look through these, they're a pretty accurate judgment of what the future is going to hold. So, in most recent times, most people will tell you simply to put money into the S&P 500. That is the index fund VOO or VUAG if you're in the UK. That has historically proven great returns, and over its entire lifespan, an average return of around 10%. Now, while that may not sound very exciting, after a few years, it starts to compound and becomes very, very exciting very quickly, especially if you invest the same amount each month, every single year. Now, of course, you can choose other funds. You can choose to further diversify, such as my personal favorite is having a fund across American markets and then a fund across global markets, excluding American markets. You can even invest in individual stocks if you really think there's one particular stock that's going to do well soon. However, like I said, all stock investing can be risky, but just because it can be risky does not mean you should avoid it or put it off or say it's too complicated, for it really isn't. You can simply put money into the S&P every month and sit back and watch your money do the work for you. This is the beauty of compound interest and will set you up a great deal for your future life. Remember, you are going to grow old. Tomorrow will come round. And would you rather be richer tomorrow or just still be poor every day, day after day, looking back at all the things you could have invested in and could have bought? I know which one I'd rather choose. Anyway, that's a quick whistle-stop tour on investing. Please feel free to like, comment, and subscribe. Thank you very much.